Imagine waking up on the first of every month and seeing money already sitting in your account. And you didn't work a single extra hour to earn it. No overtime, no side hustle, no chasing clients. Just money showing up automatically. That's not a fantasy. That's dividend investing. And today, I'm going to show you the exact numbers you need to make $1,000 a month from it. Broken down simply, honestly, no sugarcoating.
What's up, everyone? Welcome back to the channel. I'm Kevin Investing, and this is where we talk about building real wealth in plain language. If you're new here, hit subscribe. We drop content every week that actually helps you understand money better. All right, let's get straight into it.
Quick foundation first. When you buy stock in a company, you become a part owner of that business. Certain companies, typically well-established, stable ones, share a slice of their profits with their shareholders on a regular basis. That payment is called a dividend. The number that tells you how much you'll earn is called the dividend yield. It's the annual percentage return you get just from holding the stock.
Simple example. You put $10,000 into a fund with a 4% dividend yield. That gives you $400 a year, or about $33 a month. Now, the real question, how much do you need invested to pull in $1,000 every single month? That's $12,000 a year. Let's reverse engineer that number.
There's no single answer because it depends on where you invest. Let me break down 5 different approaches. Path 1. Dividend index funds, the safe route. These are diversified funds packed with stable, reliable companies. Think utilities, food brands, household staples. Boring businesses that have been writing dividend checks for decades.
Typical yield, around 3%. What you'd need, roughly $400,000. Low risk, steady growth, dividends that tend to increase over time. Best for long-term, patient investors.
Path 2. Total market funds, the balanced route. What if you just invested in the entire stock market? You'd collect some dividends and benefit from the market growing in value at the same time.
Typical yield, around 1.5%. What you'd need, roughly $800,000. Lower dividend income, but your portfolio could grow faster overall. Best for people who want a mix of income and growth.
Path 3. Sector funds, like energy, the higher yield route. Certain industries, energy, pipelines, infrastructure, are known for paying above average dividends.
Typical yield, 4 to 5%. What you'd need, around $240,000 to $300,000. Less capital needed up front, but if the sector struggles, those dividends can disappear fast. Best for investors comfortable with sector risk.
Path 4. REITs, the real estate route. REITs, real estate investment trusts, are companies that own income-producing properties, shopping centers, apartment complexes, office buildings. And by law, they're required to distribute most of their profits to shareholders. Essentially, you become a landlord without a single maintenance headache.
Typical yield, 4 to 6%. What you'd need, $200,000 to $300,000. Sensitive to interest rate changes, but can be very lucrative. Best for investors who want real estate exposure without buying property.
Path 5. Individual high-yield stocks, the aggressive route. Some single stocks offer very attractive dividend yields, less money required, but more concentrated risk.
Typical yield, 6 to 8%.
What you'd need, $150,000 to $200,000. One bad company decision can cut the dividend overnight. Best for experienced investors who research deeply.
Now, here's a mistake I see beginners make all the time. You're scrolling through stocks and you spot one offering a 15% dividend yield. Your first instinct is, that's incredible. I need that.
Stop right there. An unusually high yield is often a warning signal, not a reward. It usually means one of two things. The stock price has already dropped sharply, which mathematically inflates the yield number, or the company is paying out more than it's actually earning, which never lasts.
The range most seasoned dividend investors stick to, 3% to 6%. Not flashy, but dependable income beats a high number that disappears next quarter every single time.
Here's the piece most people completely ignore. And it's actually the most powerful part of this whole strategy. When you're starting out, your dividends will be small, maybe $40 a month, maybe $100. It doesn't feel like much. But what you do with those payments changes everything.
If you reinvest your dividends, using them to buy more shares, those shares generate more dividends, which buy even more shares. Over time, this cycle quietly snowballs.
Here's a real example. Start with $50,000 at a 3% yield. Year 1, you earn about $1,500. Reinvest it all. Year 10, your investment has grown to roughly $70,000, producing over $2,000 a year. Year 20, you're sitting at close to $90,000 in value, earning nearly $2,700 a year.
And that's without adding a single extra dollar after the start. Now, combine that with consistent monthly contributions, even just $300 or $500 a month, and that $400,000 target becomes genuinely achievable.
Quick but important note. Taxes matter here. If your dividend investments are in a regular brokerage account, those payments count as taxable income. Depending on your situation, your $1,000 a month could net you $700 to $800 after taxes.
So you may actually need to target $1,200, $1,230 gross to clear $1,000 in your pocket. The smarter move? Use tax-advantaged accounts first, your 401k, IRA, or Roth IRA. Inside these accounts, your dividends compound without being taxed each year, which can dramatically speed up your progress.
If reliability is your top priority, look into what are called dividend aristocrats. These are companies that have raised their dividend payout every single year for at least 25 consecutive years straight, through recessions, market crashes, all of it. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are in this club. The yield won't dazzle you, typically around 2.5 to 3%, but these are businesses you can genuinely build a long-term income plan around.
Here's the truth that nobody talks about enough. Most people don't have $400,000 sitting around ready to invest, and that's completely okay. The actual strategy is simple: time plus consistency. Start with whatever you can afford right now. $100 a month, $300 a month, whatever fits your life. Put it into solid dividend-paying funds. Reinvest every payment you receive, and let the math work quietly in the background. You're not trying to get rich this month. You're building a machine, one that eventually pays you whether you show up or not.
So, how much do you need to earn $1,000 a month in dividends? Strategy, yield, amount needed. Dividend index funds, 3%, around $400,000. Total market funds, 1.5%, around $800,000. Sector funds, energy, 4 to 5%, around $250,000. REITs, 4 to 6%, $200K to $300K. High yield stocks, 6 to 8%, $150K to $200K.
The right path depends on your risk tolerance, your timeline, and how involved you want to be. But the most important thing? Starting today. Not when the market looks perfect, not when you feel ready enough. Right now, with whatever you have. Every single large dividend portfolio started with someone buying their very first share.
If this helped you see dividend investing more clearly, drop a like. It genuinely helps this channel grow. And tell me in the comments, what's your target monthly dividend income? I want to know where you're aiming. Subscribe for more videos breaking down exactly how to build wealth on your own terms. I'll see you in the next one.